Should Mary and Bob do a reverse mortgage to pay off their current mortgage as they look at retiring? That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel, my friends. And reverse mortgages are going to become more and more prevalent in retirement planning scenarios. So I highly suggest you get attuned to them. Obviously, I've talked about my book on reverse mortgages before. Not my book, but from Wade Pfau, Reverse Mortgages. But here's a scenario which is pretty interesting to me, and we're going to dive into this a little bit today on the front end, and then we're going to do a couple real deep dives about reverse mortgages because I think there's, like I said, it's become more and more prevalent. It will take a bigger role for a lot of people retirement plans for sure. So it's good to at least be acclimated to how they work. Now, don't just fall to Dave Ramsey that they're scams. It's just nothing could be further from the truth. Jane Bryant Quinn, I guess, and some of these other people out there. Frankly, this is just old school thinking when it comes to retirement planning, and retirement planning has changed dramatically over the last 30 years. In fact, later today, I'm going to give you the three main papers that have changed retirement planning going back to 1994 with Bill Bengen. We're going to go to 2005 with Ty Bernicki, and then we're going to go to his other paper I'm going to talk about from the Journal for Financial Planning that came out last year, maybe 2017, that I think is critical for you to understand. The 1/30 rule, and I think you'll get a lot out of that, especially if you're considering being involved in financial advising, as I've shared with people before on my YouTube channel. Don't hire a financial advisor, become one. All right, so don't forget to subscribe down below, and as always, thumbs up, comments help me immensely, so please do that. As you can see, I haven't shaved today, just didn't feel like it. It's on Sunday, getting ready to watch the Patriots. Actually, will I watch them? I don't know, man. I might not because I get too nervous. All right. So first thing we're going to do is go to Retirement Researcher, my man Wade Pfau. You can see his big mug there. Never met Wade. I've heard him interviewed a couple times, and I've read his stuff for many, many years. Absolutely. He is with McLean Asset Management. I don't know if that's McLean, Virginia. I don't know. But this, what we're going to do is we're going to go to reverse resources, calculators. There's tons of different reverse mortgage calculators out there. This is the one I like best just because, it's not being used by groups that is selling you on reverse mortgages. All right. So like you can go to reverse.org, I think, and other areas that have a sales pitch. No other way around that. And then I went to a couple today too, where you have to put in your email, and I hate that stuff. So just in this case, it's just you don't have to do anything. You just go in there and use a calculator and you are ready to rock and roll. And you should, absolutely. Even if you're not going to use reverse mortgage, it'd be silly not to know how it can work. All right. So I'm just going to use Wade's default. All right. I'm not going to change anything when it comes to 10-year LIBOR swap. I'm not going to change anything when it comes to lender's margin. Obviously, the monthly insurance premium the monthly insurance premium cannot be changed. That's to keep the FHA solid so they can actually pay the lender back if the value of your home is less than the outstanding balance, because it's a non-recourse loan on reverse mortgage, which means the most that they can get from you is 95% of the current value. All right. Or, they can't. So even if your home is worth less than your mortgage, they cannot get more than 95% of the appraised value, which is cool because there's no risk to you at all. Or your heirs. They're not going to have to come up with $100,000 to make good on a reverse mortgage that's worth more than the house is. It's a non-recourse loan, which is very, very significant. But the reason they can offer that is because his insurance program. All right, so in this case, I'm looking at Mary and Bob, or I will say Mary and Bob. I don't know. Let me write that down so I forget. Mary and Bob. They have a home that's an $850,000 value. So what we're going to do is go change this to $850,000. All right. Let's see what else they're asking me here. Mary is 63 and Bob is 67. So we're going to say the age of the youngest eligible borrower, which in this case would be Mary. Spouse, round age up if birthday falls within 6 months of the first day. Well, in this case, we're just saying 63. So right now, Mary is 63. Bob is 67. The only thing that matters in this case is Mary's age, almost like a second to die life insurance policy. They're more worried about the second, the more long-lived, the more longevity of the spouse relationship. In this case, it'd be Mary. She'll live longer than Bob for sure. She's a woman and she's younger. They don't care about this unisex in this regard, but they do care about the age of the youngest borrower. All right, so they have, we're going to go down here. So basically with this alone, they have a principal limit factor on the most an home equity conversion mortgage or reverse mortgage, and we can type here, determined by comparing the appraised value, which is 850, versus the FHA lending limit, which is 679. The eligible amount is the lesser of those two. So in this case, the HECM reverse mortgage eligibility amount is $675,000, $679,000. Now you were using a 10-year LIBOR swap rate. We click on that. The interest rate is used in a calculation to determine available credit through the HECM, last updated on January 20th at 10:37 a.m. Eastern time. The lender's margin, all right, let's click on that. This interest rate would be provided by the lender as part of terms for the proposed loan. It is generally between 2.25% and 4%, and it remains fixed for the duration of the loan. It provides a source of revenue for the lender. It is using calculations on the initial available amount and the growth of the principal limit. So it's both things. Not only does it use to determine how much you will pay back via interest, but also how much your line of credit will grow as well. So that's kind of interesting. So it's a win for you, and it's a win for the bank as well. All right, monthly insurance premium. We'll just go through these. Used to support the government's insurance fund that provides guarantees to both the lender and the borrower. For all loans issued at present time, that remains permanently fixed as 0.5%. All right. So in this case, the principal limit factor is, 41% of this amount right here, 679. All right. So the principal limit factor is 41%. We can click on this. The principal limit factor represents the credit capacity available with the HECM reverse mortgage. Principal limit factors are published by the HUD, Housing and Urban Development. Factors are updated over time to manage the risk to the insurance fund. Last updated were October 2017, which a big changes happened to make it more solvent for the insurance fund. They are calculated based on the age of the borrower. In this case, is Mary at 63. And the modified expected rate, which is the 10-year LIBOR plus the 10-year LIBOR plus the lender's margin. So these two things right here and the age, all right? Modified expected rate, we can click on that. The expected rate is a 10-year LIBOR swap rate plus the margin, the lender's margin. The modified expected rate makes two adjustments. It contains the expected rate to be between 5 and 10%, and around the nearest 0.125% or 1/8%. So in this case, we take our trusty calculator and we say 2.25 plus 2.78 gives us a 5.03 margin. It's actually, they're going to round down to 5% modified expected rate. So essentially you're saying that's what the growth will be on both sides of the equation. The amount I owe them, the debt, and the line of credit that I have if I want to do that as well. So it grows on two different aspects, which we'll get into here in a little bit. Their loan origination fee, we're saying zero, simply because, like Wade talks about, you can go to lots of different lenders and negotiate loan origination fees. Now, they might say, we're going to pay no loan origination fee, but we'll charge a higher lender's margin. Absolutely. So in this case, we're just using a 0% loan origination fee. And let's see if Wade talks about this a little bit. The initial fee charged by the lender for processing the loan. The maximum amount allowed to be charged is controlled by the government as a function of the eligible amount. Lenders are welcome to charge less than the maximum. The maximum amount allowed to be charged is provided next to the box, which is $6,000. So again, if you got a loan origination fee, you'd want to use that as part of your negotiating tool if you're doing a home equity conversion mortgage or reverse mortgage. Initial mortgage insurance. Let's see what this is. This is the insurance premium charged by the government when the loan is made. It is based on the HECM eligible amount. So that's this is the HECM eligible amount right there, $679,000, and that is what goes right into the insurance, the government funding to make sure, again, that they can provide non-recourse loans to lenders. They do not want lenders to be on the hook to chase after your heirs if the loan is worth more than the mortgage when you die. So they're going to say, lender, you have no risk to you because we're going to charge the borrower this pretty significant initial mortgage interest insurance amount, which again is based on this amount right here. So 13,000 divided by 679 would be about 2% of is basically, so whatever, it's 2%. Let's just put it that way. Whatever this amount is here, regardless of how much you borrow, is going to be 2% of your eligible amount for a loan. So if your loan is for $200,000 is your eligible amount, yours can be $4,000. In this case, it's significantly higher because the house is worth a lot more. All right. So now we're going to other closing costs, appraisal, titling, $2,500. Now we'll see what Wade says here. Additional closing costs. So you might be able to negotiate that again as but hard to imagine that going away. Some because they got to do the title work and appraisal. So total upfront costs are $16,093. Percentage of costs we finance, we're going to say 0. We're not going to put any on the loan. We're just going to pay it out of pocket. We can change this around if we want. Debt repayment. All right, so we're going to talk about both these things here in just a second. So percentage of upfront costs to be financed, there'll be percentage of the loan amount that'll be added to the loan balance. If all loan costs will be funded from the other assets, the percentage is 0. So I want to actually say 100% will be funded in the loan amount. All right, so watch what happens here. If we finance the loan, if we don't finance any of the loan costs, we have a line of credit or a reverse mortgage amount available of $282,000. If we finance the entirety, we have a reverse mortgage credit of $266,000. All right, I hope that makes sense because we're adding it to the loan. Now, here's where it gets interesting. If we don't have any debt on this property at all right, we have $266,000 line of credit available to us, which means we could take this as a 10-year payment over the course of both borrowers' lives at $1,400 a month if we wanted to. And if we click on this guy right here, the monthly and annual amounts available as 10-year payments, which last as long as the borrower remains eligible for the loan, i.e., as long as they're alive and they own the house, essentially. And so what Wade would say is, look, that's $1,400 or $16,000 a year divided by your home equity conversion mortgage credit amount. That's a payout rate of 5.97, tax-free, which is pretty good. Absolutely. That's a pretty good payout rate. You're not going to find that in other accounts. I'll tell you that right now. So that's pretty good. Of course, this is just paying you back your principal. So it should be pretty good, but that's not a bad deal, especially when it comes to like annuities and things of that nature. Now you can do a term. You can say, look, I just want it for 20 years. So in this case, Mary would be 83. She could get 1830, but then it stops at that point. So I'm not a big fan of term. I like the 10 years, essentially an annuity, but we're not doing that because Mary's got $230,000 right now in their current mortgage. So what we're going to do, we're going to finance the upfront cost, and we're going to put here $230,000 on the current mortgage. All right, boink, boink, boink. And so what that does here is it leaves a line of credit available to us at $36,641. But that's not the point of this. The point is it's going to free up, in this case, $1,212 in monthly payments that Mary's got. She still has $230,000 left on this mortgage, and it's cost her $1,212 a month, and that's just principal and interest. That is not taxes and insurance. So PI as opposed to PITI. So PDA or PD is principal, interest, taxes, and insurance. When it comes to principal and interest, her payment is $1,212 a month, and she's going to have it for many years yet to come as she goes heavy into retirement. So now what we've done is to say, now forget all that. We're going to put this on a home equity conversion mortgage, a reverse mortgage. We're going to pay all that off. And now we no longer have $1,200 a month that we have to, that we'll spend on the mortgage. We don't have that anymore. Now it goes away. Now what's going to happen is this $230,000 plus the $16,000 is going to be going at basically a rate of 5% a year. So that's going to be probably significantly higher than what her mortgage interest rate is right now. And that is, that's just the way it works. So you're probably going to pay more in interest off this than you would on paying your home down with the interest that you got on your first mortgage. But we also don't have $1,212 a month going out each and every month. For many years to come. That frees up. So in theory, we could turn around and invest that money if we wanted to, and hopefully get 6 or 7 or 8% in the market, whatever. Or we could just use it to not to go in debt for other things because we freed up $1,200 in cash flow, and that's almost $15,000 a year right there. Now, what's also going to happen is this remaining home equity line of credit or home equity conversion mortgage line of credit is also growing at this 5%. All right. So basically what we can say is that, we'll just do 36,406 or 36,641, and we'll say 5%. We'll say it's going to happen for 10 years. So that will be worth $59,600. Let's just say $60,000. So in 10 years, Mary will be 73. It gives her another $60,000 from which she can draw on should she decide. Now, what will happen in that case? The remaining mortgage here, this balance will go 243. Present value will be worth $395,000. So that mortgage, the debt is also growing at that 5%. So that debt is growing at 5%. So now she owes $395, whereas before she only owed $230. But she does have this line of credit that's also growing at 336 or 5% a year. And so essentially, that's how it works. So you have the line of credit that grows at 5% a year. You got the debt that grows at that 5% a year. Now you say, "Oh, but Josh, now she owes $395,000 when she started with a debt of, $246. So now she owes let's just say $150,000 more than what she did before because she only owed $230 and now she owes $395. So she owes $195,000 more or $150,000 more than what she did before. So what we'd say is, well, let's see if we can't make, bear with me just a second. We're going to do 12. I'm going to do 12 payments a year. So let's just say we took that $1,200 a month and we put that into a mutual fund that grew at 6% a year, just for simplicity, 6% a year. And we did that for 10 years. That'd be worth, So we did that for 10 years. We do 10. There we go. That's 120 payments at $1,200 a month, and that'd be worth. Why do I keep doing that? All right, hold on just a second. Blink. $1,200 a month is our payment. 0 is our present value. We're doing it for 10 years, and we're getting 6% interest. Why am I having such a hard time with this? There we go. That's what I need to do. Bear with me just a second. Got to change this over. There we go. Okay. That'd be worth 100. Man, I'm having a hard time with this for some reason. Let's just jeez Louise. Let's just do it once a year payment. Oh my land, 6%. And we're doing it for 10 years. That'd be worth, I don't know why I'm having such a hard time with this. I'm not sure what that'd be worth. My calculator is on the fritz. If I do the right thing, 12 is our payment, 0 is our present value, 6% is our thing, is our interest, doing it for 10 years. Got 15,816, but that's not, is that, why is that? One payment a year, yeah. I don't know. Anyway, I don't know what that'd be. I don't know why my calculator's messed up. Either way, if you got no interest at all and you did 12,000 for 10 years, it's still be worth $120,000. I mean, that's just all there is to it. I'm not sure why my calculator is messing up on me there. I'm obviously doing something wrong, but I don't know what I'm doing wrong. It's showing up as 158 or 15,800. And so, anyway, either way, you get the gist. At the end of the day, could you have more in the account than what you did if you didn't do it? And the answer is yes, you could. Could you have less? Absolutely, you could. But either way, you don't have $1,200 going out the window each and every month for principal and interest. That is coming back to you to spend as you see fit, which is nice. Absolutely. And you still have this line of credit growing at a clip of 5% on top of that as well. Now, if the LIBOR rates change, that will change with you. So the loan could go up, the loan could go down, but so doesn't your line of credit as well, if that makes sense. So in this case, we're saying, okay, Mary, if it's important to you to free up that $1,200 and you're going to stay in this house, which she says she's going to do, I would absolutely say take the reverse mortgage. Now, you want to shop around. You don't want to pay an origination fee if you can avoid it, and that might mean you pay more of a lender's margin. That's fine. It's completely acceptable for you to do. You just got to shop around. You're not going to get rid of the mortgage insurance. It's going to be there. I promise you that, because it's a 2% fee. You can pay it out of pocket. You can do whatever you want with it, but it's got to be paid either through the mortgage itself, the loan, or just you stroking a check. But that is how this works with reverse mortgage. Now, next video we're going to show you four different scenarios using Journal for Financial Planning. Some of the folks who write articles in there, which I'm hugely fan of, which is critical to see how this can really work to benefit you in retirement. And it's going to be one of my three, most seminal articles that have changed the face of financial planning for the last 30 years. Not the face diversity stuff. No. Just a structure of how we do financial planning. Again, going back to Bengen in 1994, going back to Ty Bernicki in 2005, and going to this article in 2017, the 1/30 rule as opposed to 4%. So stay tuned because that's critically important. You'll get a lot out of that. All right, don't forget to subscribe down below, my friends. And if you have questions, thoughts, concerns, comments, put them down there for sure. And we will see you next time. Thanks, guys.